Hey, it's Amy. Welcome to my part 2 of the breakdown for the 2022 ICT mentorship on YouTube. This will cover from 18 minutes until 35 minutes of the 1 hour long video, and the link to my PowerPoint will be down in the description if you need it for studying. So let's get right into the video. The ending of my part 1 was covering the most likely bias. So it's not 100% of the time, but the highest probability of us building the narrative is to look for a 3-candle swing low. Once you have a swing low or a swing high in the proper context and you know what you're looking for, that's when we go and we hunt these setups.
You only need 3 candles. Once you get swing low or swing high and you have the proper context and you know what you're looking for, that's it.
So this slide here says, what is a 3-candle swing? A 3-candle swing low or high is used as a foundation to build our bias. When it is formed, we see swing lows and highs as pivot points, as the most likely clue for reading price action. We're using 3-candle swing lows and highs to read the nature of price and speculate where it may be magnetized towards next.
Not everyday bias. Most likely, what's the bias going to be? Well, let's go back to this low over here. It creates a swing low. It means a low with a higher low to the right of it and a higher low to the left of it. So it's 3 candles that make up a swing low.
From 1930 to 1945, the rally up supports this as a swing low, which is the 4th candle, because it didn't take out the lower low, the 3rd candle. So between this low and this low, this is the lowest low, which is the 2nd candle. And that is how we determine a true 3-candle swing low for me.
The rallying up on this candle here closing on the high, that supports this as a swing low because it didn't take out the lower low right here in the middle. Between this low and this low, this is the lowest low of the 3 candles or price bars.
From 1954 to 2017, this slide is explaining how this is the ideal setup because we have a true 3-candle swing low with the 4th candle not passing the 2nd or the 3rd candle into a fair value gap, as you can see here. He says the next day after the 4th candle, we're likely to go into this area here. That's an opportunity. That is a trade. So this would be the ideal setup.
I only need to open and start to rally and get up in this area here. That's an opportunity. That's a trade.
And in this slide, I am sharing what my trade setup plan would look like using Michael's words when he says the next day we're likely to go into a fair value gap. So I have setup conditions here. In my condition, I wrote number 1, the 2nd has to be the lowest candle. The 2nd condition I have is the high fair value gap has to be present. When that 3-candle swing low is occurring, we are looking for a fair value gap in yellow. We are anticipating for price to trade into that. Number 3, I wrote there's room to the upside before buy side liquidity is reached. As you can see with this blue arrow, that is room to the upside until buy side liquidity in purple there is reached. Number 4, I wrote we're entering at the 4th candle. So from a 3-candle swing low, and we are anticipating for price to go into a fair value gap, we want the ideal setup to have room to the upside, room till we reach buy side liquidity. And that is when we would enter our 4th candle. From 2020 to 2114, I wrote a 3-candle swing low and a retracement anticipation. So when we have a 3-candle swing low, we are at the same time anticipating for price to retrace. Michael says here, when we traded up into this area, the next day we are seeing the market trade back down into this run. And how far we can go down, how far price can come down is subjective to that rally up. We're expecting for price to retrace below equilibrium, the 50% mark of the Fibonacci tool, and to offer a discount to bring price up.
Next trading day here, what are we seeing? We're seeing the market retrace back down into this run. How far can it go down? Well, look at your high down to your low. Equilibrium is probably going to go below equilibrium to do what? To offer the market a discount.
So in this slide, I have examples of when price is not offered a discount to create a premium. But what happens more often than not, as you can see from my own backtesting, I have shown here that price is offered the discount and comes up from the 50% mark, regardless of if we are in a bullish or a bearish market. From 2205 to 2223, this is when we have the daily bias being bullish. So Michael says the bias here is bullish because we're aiming towards relative equal highs. And he's saying that there are stops above these highs. There are stops above buy-side liquidity. When we are bullish, we have this 3-candle swing low into sell-side liquidity in this purple dotted line here. That is short-term lows being traded into. And after we have a 3-candle swing low, a perfect 3-candle swing low into the sell-side liquidity, we are anticipating for price to be drawn towards short-term highs after it is offered the discount.
What's the bias? What are these over here? They're relative equal highs. There's stops resting above that. That's buy-side liquidity. What's it drawing up to? We already taken out this high. What's going to go up to here likely, right? Because we've already taken out sell stops below here with this drop. And we keep proving it's going higher.
I have a slide here that says how to approach buy-side liquidity after a retracement. So how we approach buy-side liquidity is to stick to your bias. So what this means is when we are bullish, we are less likely to have down closed candles, but we will still have down closed candles in a bullish trend, but we're not going to abandon the logic that price is going to be magnetized towards these highs.
In here. You might get stopped out. You might have a losing trade, but you're not abandoning the bullish bias until we get above these highs. It's expanding, it's accelerating higher. Each day, we're looking for longs. Opening near the low, trades below the opening a little bit, and then rallies and closes near the high. That's bias. That's sticking to your bias.
So here's a bearish example of when we are bearish in our daily bias. From 23.29 to 23.34, Michael says, here's a fair value gap, and that's in orange. We trade up into it. And once we trade into it, what are we expecting the market to do? We are expecting for the market to trade back lower.
And the same thing is done over here on the opposite. We have imbalance here. And I promise after this, I'll change the candlesticks. Your eyes are probably going nuts right now. Fair value gap, we trade up into it. So once we trade into it, what are we expecting the market to do? What? Trade back lower.
From 24.05 to 24.31, I have a slide here that says how to approach sell-side liquidity after retracement. Michael says here is where that sell side is now, which is in this yellow dotted line. So here he says each candle is an open, rally, and then close down on the low. They're learning to hold until the close of the day. What is the difference? What is the difference for when price is offered a 3-candle swing low and rallies up and offers a discount and trades back lower? Versus what happens when price is offered a 3-candle swing low into sell-side liquidity, rallies up, a discount is offered, and it continues heading towards buy-side liquidity to the upside. What is the difference? The difference is context. For example A, when we are bearish, we have a 3-candle swing low at sell side liquidity. But before that happened, we had buy side liquidity being traded into. And that's why we have a bearish bias, is because we just took out highs up here in pink. We just took out buy side liquidity before we had that 3-candle swing low at sell side liquidity. In context B, the difference is that before we had a 3-candle swing low, we have not taken out any buy side liquidity, and that is why after we had that 3-candle swing low at sell side liquidity, the reason why we are bullish in this example is because we have not taken out any buy side liquidity. From 25.38 to 26.02, we have a 3-candle swing low into sell side liquidity, but before that we had short-term highs traded into. And so when price worked the upper end of the fair value gap to the blue line, that supports our bearishness.
All right, let's drop down to an hourly chart. And that fair value gap, the high and the low levels, that's what's being shown here, right there. So watch what happens. The market trades down, finds some support at the low end of the fair value gap, then rallies back up to the high end of the fair value gap.
So from 27.08 till 27.14, as you can see in that green square at the hourly chart, that is what price looks like at the 15-minute chart. So it says here, imbalance, we rode up into that, rebalancing all this movement down. And at 8 a.m. New York time, that is when we had that push to move price bearishly.
All right, 15 minutes, I'm going to take a look at this imbalance here. We rode up into that, rebalancing all this movement down.
So from 27.19 to 27.46, this slide is showing the 15-minute inefficiency. Michael explains all this movement given to that one single candle, there's going to be pores, and we are expecting for price to be efficiently delivered, which is when the imbalance is filled.
All this movement was given to that one single candle. There's going to be little porous places in prices between the high and the low where the market wasn't efficiently offered for buyers. There wasn't much time and back and forth pricing to give buyers an opportunity to get in there and participate. So an efficient market, we'll see the market go back up and reprice that. So it's down and then right back up.
From 30.02 to 30.23, we have a power of 3 anticipation. The reason why we are expecting a sell-off is because we just took out the buy side liquidity, and we worked the upper end of the fair value gap, meaning we rebalanced the entire range at the daily chart. And we had, number 2, multiple shifts in market bearishly when we already had a bearish bias anyway.
The idea is we're expecting this power 3 formation where it's open, rally, create the high of the day, sell off, and close near the low. That's what we're looking for. Why would that bias be expected on this day? Because we worked the upper end of that fair value gap on the daily chart. Then we had multiple shifts in market structure bearishly.
From 30.45 to 31.03, we are explaining what we're looking at when we're anticipating the power of 3. What we're referring to is that yellow tick right here is the opening, and then up into that star is the rally up, and then that whole orange box is when we have the sell-off.
That right there is equivalent to this little tick on this diagram here. It opens, it trades above the opening, just like that candle does on the daily chart. It opens and goes higher. You want to be selling short here.
From 33.14 to 34.08, this is how sells form. In this slide, I have projected the opening to the high, and I projected that down, and that is the area in where we can find sells.
From that opening price to that high, that's the highest high. Take that range and subtract it from the opening price. That's about in this vicinity here. Okay.
From 35.47 to 35.59, which is the final slide, here we have where our sell entries will form. He says the setups are forming here above the opening price, right here near the opening price, and inside the range from the highs to the opening projected down, and it is in that vicinity. These are where we are expecting for sells to form when we are anticipating for a down close candle day.
The setups are forming here above the opening price, right here near the opening price, see that? And inside of the range from the high to the opening projected down, it's in that vicinity there. So it's giving you another opportunity.
And that covers my breakdown of episode 10 ICT 2022 mentorship. Like I said, if you guys want the PowerPoint to this, it is going to be in the description. And thank you so much for watching. See you in the next video. Bye.